The market just blinked, not a cute little dip. A blink that usually happens right before a staircase turns into an elevator. In the last few weeks, the biggest names on the board didn't fall together. They peeled off one by one like a roof, losing shingles before the whole thing caves. That's the event. A cluster of major peaks across mega caps, crypto, and safe trades, followed by stress signals in the plumbing of money itself. And if you're thinking, okay, so what? Markets rotate. Good. Keep that skepticism. We need it because the scary part isn't the rotation. The scary part is what the bond market is whispering while everyone is cheering the stock ticker. I'm your host, and this is our channel. Let's get into it. Here's the first trap most people fall into. They look for one big crash candle, one dramatic day, one headline that tells them, now you may panic. Markets don't work like that. Big tops are usually silent. They look like a party where the DJ is still loud, but the exits are already jammed. So we did something simple and brutal. We lined up the peak dates of the most crowded trades people have been chasing. Mega cap tech, consumer darlings, banks, chips, AI hype names, crypto, even the safety assets. And we asked a cold machine brain a blunt question. Do these peaks mean anything? Not predict the future, not tell us a story, just are clusters like this a symptom of something bigger? And what came back was not comfortable. One model basically said, this is a rolling top. Another model said, slow down, you're overfitting. Then we pulled in a third voice to judge the fight. 3 different minds, same raw list. One conclusion, the surface looks fine, the foundation looks tired. Now watch this. A healthy bull market is like a marching band. The drums, the brass, the flags, everything moves forward together. When the band starts to break formation, you don't notice it at first. One row steps out of sync, then another. The music still plays, but it's not a band anymore, it's a crowd. That's what rolling top means in plain English. Not everything crashes at once. The most stretched, most sensitive, most hyped trades get shot first. The generals wobble, then the soldiers keep marching for a while. Then the whole army realizes the map was upside down. In our data, that's exactly the vibe. Early peaks in some of the pure, expensive momentum names, then later peaks in the everyone owns this, big tech, then late cycle strength in banks and broad indexes. Meanwhile, a bunch of risk-on stuff, crypto, hot chips, the darling brokers, hit highs and started slipping. If you're still with me, here's the key question. If the rally is so healthy, why are the leaders taking turns collapsing? Because liquidity is not a feeling. Liquidity is oxygen. And when oxygen gets thin, the strongest runners don't sprint harder. They quietly stop. The second trap is thinking prices tell the whole story. Prices are the headline. The plumbing is the story. So we added plumbing. We looked at the yield curve, specifically the short end versus the long end, because that curve is the bond market's lie detector. We looked at what the central bank has been saying in its own words. We looked at the effective policy rate. We looked at repo activity because repo is where the financial system borrows its next breath. And when we fed that into the same machine brains, the tone changed from maybe to this could get ugly. Here's the weird part. A lot of people think an inverted yield curve is the recession signal. They camp on it like it's a campfire story. It's inverted, therefore crash. But history plays a meaner game. Often, recessions show up after the curve starts to uninvert, after it steepens. Not because things got better, but because the market starts pricing cuts. And cuts usually come when something breaks. So if you want one clean tell, it's this. When short-term yields fall hard while the policy rate is still high, the bond market is basically screaming, you're late. Late is not a vibe. Late is a hazard. Now, I'm not here to tell you to short everything like a cartoon villain. We're not gambling. We're measuring. This is educational. We manage risk. But we are going to be honest. When the short end drops under policy and the curve steepens for the wrong reasons, it's not a victory lap, it's a smoke alarm. And here's where it gets spicy. At the same time those peak dates were stacking up, repo started acting like a stressed engine, not necessarily exploding yet, but revving in a way that says someone needs cash fast. Repo is the overnight pawn shop of the financial world. Banks hand over high-quality collateral to borrow cash. When that pawn shop gets crowded, it means the system is thirsty, and thirst is invisible until it isn't. One model's interpretation was aggressive. This looks like a liquidity peak. Everything topped. There's no safety net. Another model pushed back. Hold on. Some of this is seasonal. Year-end treasury flows. It's not proof of collapse. Good. That's the kind of disagreement we want, because the market doesn't pay you for drama. The market pays you for being right enough, early enough, with the right size. So we let the third voice judge which argument was stronger. The judge said, the disciplined model wins, the one that refuses to leap without evidence, the one that separates signal from story. But then the aggressive model did something interesting. It conceded the judge was mechanically right and still refused to change its warning. Why? Because you can be correct and still get wrecked by timing. If the building is on fire, you don't wait for the roof to fall before you walk out. That's the core tension for us right now. So what do we do with it? We focus on 3 to 5 things. Not 20, not noise, just the levers that matter. First lever, leadership fractures. When leadership rotates from growth to safety while indexes grind higher, that's not always bullish. Sometimes it's the crowd buying the last sturdy chair before the music stops. If AI hype peaked, crypto peaked, and the broad index is still smiling, ask yourself, is this strength or is it the last mask on the party? Second lever, the bond market's message. If rates are cutting in the bond market's imagination while policymakers talk tough, that contradiction matters. What's the market paying for, growth or safety? If growth is so strong, why would the 2-year yield slide like a wet bar of soap? Third lever, funding stress, repo, liquidity lines, quiet tweaks to emergency backstops. You don't lift the ceiling on an emergency facility because everything is fine. You lift the ceiling because you don't want to be caught with the door locked when everyone shows up at once. One more time. Not proof of a crash, but it's not nothing. Fourth lever, credit, high yield spreads, junk versus risk-free. Credit is the grown-up in the room. Stocks can cosplay. Credit usually can't. If credit starts widening while stocks are still partying, that's the floorboards creaking. Now, here's the open loop you need to keep in your pocket. If the market really is topping, where does it show first? Not in your favorite headline stock, not in your feed. In the boring places, in funding and credit, in the quiet corners nobody likes to watch. That's why this matters. Because the crowd is trained to stare at price. The pros watch plumbing. Now, let's talk about the AI debate angle, because that's the viral hook here and also the caution. AI is not a crystal ball. AI is a mirror. It reflects the data you feed it, plus the biases baked into its training. So, when one model tells a compelling bearish story and another model says, slow down, the value is not the prediction. The value is the map of risk. And the map says, we might be in that cartoon moment where the character runs off the cliff but hasn't looked down yet. If you're feeling that in your gut, you're not crazy. That's exactly what late cycle feels like. Everything looks normal until it doesn't. Here's the mistake most people make next. They either go all in bearish or they ignore it completely. Both are emotional. We don't do emotional, we do scalable. So instead of short everything, we think like this. Position size is a dial. Risk is a dial. Exposure is a dial. We can turn them without smashing the whole radio. If you're heavily concentrated, we consider trimming the froth. Not because we're sure of doom, because concentration kills you faster than being wrong. If you're over-levered, we consider delevering, because leverage turns a normal drawdown into a liquidation event. If you have no plan, we build triggers. And yes, we keep upside exposure, because if the discipline model is right and the market just keeps grinding, we don't want to be the person watching from the sidewalk, angry and broke. So what are the triggers? Watch the curve. If the steepening accelerates while growth data weakens, that's a red flag. Watch credit. If spreads start widening meaningfully, that's a red flag. Watch repo and funding chatter. If temporary operations start looking permanent, that's a red flag. Watch breadth. If indexes rise while fewer stocks participate, that's a red flag. And watch the psychology, because the final phase of tops is not fear, it's complacency. It's the feeling that nothing bad can happen because it hasn't happened. That is the most expensive sentence in markets. Now, let me ask you something that forces thinking. If corporate profits are fine, why would funding markets need bigger safety valves? If stocks are healthy, why do so many leaders peak early and quietly roll over? And if the soft landing is guaranteed, why is the bond market pricing cuts like it's already seen the accident? That's not me being dramatic. That's the contradiction on the table. Here's the uncomfortable truth. We might be in a regime where both sides have a point. It's possible the market avoids a 1929-style wipeout. It's also possible we get a sharp, fast repricing because valuations are stretched, positioning is crowded, and liquidity is fragile. Those are not mutually exclusive. The crash doesn't need to be the end. It just needs to be enough to punish the wrong leverage and the wrong complacency. And that's why we care, because we don't need to be prophets. We need to be prepared. So here's the playbook in plain language. We keep exposure, but we harden the ship. We hold quality, but we stop worshiping narratives. We take profits in the most crowded trades when they stop acting right. We keep cash as optionality, not as fear. We avoid being forced sellers. That's the entire game. And yes, we can still make money in a messy tape, but only if we stop acting like every week is guaranteed. Now, a quick one-line disclaimer again because it matters. This is educational. We manage risk, and you should make decisions based on your situation. All right, before we go further, I want to drop 2 questions for you, because the comment section is our edge and we learn faster together. Question 1, If you had to watch just one indicator for early 2026, would you pick the yield curve, credit spreads, or funding stress? And why? Question 2. Do you think AI models are making traders calmer, or are they making complacency worse because everyone can outsource thinking? Drop your answer. I read them. We build better frameworks together. Now, there's another layer here people are missing. The no one is bearish problem. Late in cycles, consensus becomes a warm blanket. You hear, next year will be up from every polished voice in a suit. And that's when risk gets mispriced, not because markets must crash when people are bullish, but because positioning becomes one-sided. When everyone is leaning the same way, it doesn't take much to knock the crowd over. A slightly hotter inflation print, a slightly weaker jobs number, a funding hiccup, a geopolitical jolt, anything. And because leverage is hiding everywhere, options, margin, structured products, the unwind can be fast. That's why the rolling top matters. It's the market quietly reducing exposure before the public notices. Now you might be thinking, but the index still looks fine. Exactly. That's why this has viral potential. The chart says calm, the underbelly says tension. That contrast keeps people watching because deep down everyone feels the same question. Are we about to get blindsided? And the honest answer is, we don't know. But we can see where the cracks would appear first. So let's zoom in on the peak list concept for a second. Why does a peak cluster matter? Because in momentum markets, the crowd chases what worked last month. When those leaders stop working, the crowd doesn't stop chasing. They just switch costumes. That's how you get the illusion of strength. The index stays up because money rotates into whatever still has bids. But rotation is not infinite. Eventually, you run out of chairs. If the safe stuff starts peaking too, banks, staples, even metals, then what? That's when the market stops being a rotation and starts being a withdrawal of risk appetite, a withdrawal of liquidity, a withdrawal of patience, and withdrawals are contagious. Now remember our trust framework. Fact, peaks in multiple crowded trades can happen in clusters. Fact, yield curves have a history of signaling late cycle stress, and the uninversion phase can matter. Fact, funding markets like repo can show stress before equities. Interpretation, the combination suggests fragility under